There was a massive meltdown in Japan's government bond markets last Tuesday, and investors are bracing for more volatility. And stress in Tokyo could turn into stress for Wall Street and beyond. Yields on 30-year, 40-year Japanese debt spiked on Tuesday. Higher bond yields mean higher borrowing costs. Now remember, Japan was home to ultra-low interest rates for decades, providing an anchor to borrowing costs around the world. The nation has some of the biggest piles of debt in developed markets after years of large stimulus spending. Low interest rates meant Japanese investors bought trillions of dollars of overseas assets to get better returns. But when bond yields jump, some of these bets may be forced to unwind. Take last week, for example, as bond yields spiked. Treasuries fell and the euro to the dollar jumped against the yen. The moves were so seismic that by the end of the day, US Treasury Secretary Scott Bessent had called his Japanese counterpart, Finance Minister Satsuki Katayama, to tell her that the sell-off had been felt in American markets. So what's happening domestically in Japan to move markets so drastically? One of the big factors is the snap election on February 8th. Prime Minister Sanae Takaichi has pledged to cut some taxes without saying how she'll pay for it. Bond investors don't like that. Even with so much uncertainty ahead, some are optimistic.
There's no question that, given the setup over the last 30 years, there's bond market volatility in Japan. Japan needs, a more outward-looking economy and more growth, to really get to a different place than where it's been over the course of the last 3 decades. But we're actually quite excited because we see pensions and corporates in Japan, looking more outward. We see a culture of risk-taking developing in Japan that really hasn't existed for the last 3 decades.
But if there's one takeaway for all the global traders out there this year, it's watch Japan markets.